It is super popular. If you guys haven't checked it out, you need to go to iTunes right now and make sure that you subscribe to Chris's podcast. You're going to love it. Chris is an expert on shorting flawed companies, the insanity of the U.S. macroeconomic environment. We can all appreciate that. And he really leans toward the Austrian school, which all of us do as well. You guys are going to love this conversation, but forewarned, it's the raw, uncut version, so there is quite a bit of explicit adult language. With that disclaimer out of the way, let's dive right into the interview. All right, so my first question would be, I've been listening to your podcast for a long time. It's one of my favorites.
Thanks.
And you're obviously a real smart guy, got a lot of common sense, but you're not exactly the typical Harvard, Wall Street type of guy.
Right.
So how did you get to where you are today? You got so much knowledge of not only short selling, but macro from an Austrian standpoint. You got this super popular podcast. How did you get here?
Well, it's really a long story, but to boil it down, I went to college as a business and technical writing minor and an English major. Okay. I came from a background where I always had strengths in writing and reading and writing comprehension, and I was always very good at logic and deductive reasoning and problem solving and those types of things. So, as an undergrad, I wasn't really sure that I wanted to go into finance. But I had always kind of like had that skill set, and I was always messing around in the markets on my own. So I started to try to invest and try to trade when I was, beginning when I was 18 and I could open a brokerage account. And I was quite unsuccessful in all of my endeavors, ranging from trading equities to options to Forex to futures. I learned about all those instruments the hard way, which is to just blow through your money. And then I went to graduate school and took a program that was like a business program where I got my first introduction to, like basic financial analysis, doing just basics, balance sheet, cash flow statement, income statement, stuff like that.
So bottom up stuff, not really the macro.
Right. Yeah, exactly. Just doing like basic equity valuation type stuff. And from there, I started to kind of take all of the stuff that I had been seeing through my unsuccessful exploration of the capital markets and start to understand it a little bit better. So I start to understand kind of like what these numbers on the screen that I was looking at every day actually meant. Like, what the hell is a market cap? Like, I had no idea. I used to think because the stock traded for 2, it was cheaper than a stock that traded at 50. When one could, the stock with 2 could have a market cap of 100 billion, and the stock at 50 could have a market cap of 10 million, and you wouldn't know the difference. So I just hashed out a lot of those basics then. Then I went to work for a startup company. After I finished graduate school, I was bartending at this pub in Philadelphia called McGillen's for like 5 years. I left there to go up to Niagara Falls, Canada to work for a startup company that was listed on the over-the-counter markets and didn't have an investor relations function internally. They had somebody on the outside doing their IR. So I was a huge supporter of the company. I had been a shareholder for years, and I was like very impassioned about the company. Of course, the company has since done horribly, but that's the way it goes. Went up there and basically started to learn the mechanics of public reporting from the inside out. So you kind of get to see how the sausage is made a little bit.
Right.
You're sitting down with CFOs, CEOs, securities attorneys, and then you start to when you're sitting down helping write an annual report, which is a horrifyingly long and insanely detailed disclosure anytime a company files it. When you're doing it on a word-by-word, line-by-line basis, you get to look at these things with a bit more granularity than the average investor that jumps into them. So, when I help prepare the annual general meeting, I had to learn that whole process. What is a proxy statement? How does an annual general meeting work? How does the vote counting work? What does all this shit mean? Hey, so you learn little by little what winds up in certain spots. And like this company didn't really have any type of IR function at all. So I was the first to kind of implement like quarterly conference calls to, try to put out a regular quarterly earnings report with some slides and with some graphs and charts and all that shit. But all the while I was learning as I was going too. I wasn't some expert on this. I was just surrounded by people that knew what they were doing. And so, lots of conversations with securities attorneys, lots of conversations with CFOs, lots of conversations with CEOs and guys that had seasoned backgrounds and some people who didn't, really helped me along the way. So while I was up there, I started writing on my own under this name, Quoth The Raven, that I now use. Basically, I was writing on Seeking Alpha just for beer money. Seeking Alpha was paying like on a per article basis. So I was just trying to earn a little bit of extra money because this company I liked so much, I was letting them pay me in stock. I mean, I got some cash, but I was also getting paid in stock because I was so confident that it was going to pan out in the long term. Which again, I have to reiterate, it did not. But you take your swings and you make your bets, and that's what happened. So I was writing to get like some extra money on the side. And also as I was doing that, and this is like 2012, this is like 8 years ago. As I was doing that, I was kind of learning things as I was writing. I would read other articles. I read like, in my lifetime, I've probably read like 100,000 Seeking Alpha articles, and just reading them over and over and over again and following guys on like, Twitter and shit like that, you start to pick up even more. Like, all right, now I've learned about equity. Now it's time to learn about the debt markets. Now it's time to learn about, the credit markets. Now it's time to learn about commodities. Now it's, so you take your understanding of things a little bit deeper. And at the time things were winding down at this company where really they were running out of cash. We had raised, I think, $10 or $15 million while I was there, but we were looking for more cash and we were having difficulty finding it. And so cuts were being made and the belt was tightening a little bit. Like right about that same time, I started to read due diligence by guys like Muddy Waters. I specifically remember reading Muddy Waters' report on NQ Mobile and just being like, wow, because it was half equity analysis and it was also half like financial, investigative research. And, I had a James Bondish feel to it to some degree because they were doing the maximum allowed due diligence that was legal to go and, go to these places and visit the headquarters and all this other shit. And especially because the places were in China. So that added a whole layer of opacity between US investors and what the fuck was actually happening in these offices, some of which didn't exist. Other ones belonged to other companies, whatever. And I started to read articles like that one. And there was another article on Longway Petroleum, which was another Chinese company that, Geo Investing had sent people there to check out their factory, and they found out, the factory was closed and the rail spur had weeds growing over it. And so it wasn't fraud like people were fucking around with the numbers. It was fraud like the place doesn't exist, which is a different level of fraud. So being a little wet behind the ears still, I was baffled that that kind of fraud could take place on the U.S. equity markets, and that, NASDAQ or Ernst & Young or whoever the hell was auditing these guys weren't going over there and verifying this stuff. Like, all you do is you pay your exchange listing fees and pretty much you take your flaming pile of dog shit and you list it on the New York Stock Exchange, and like nobody fucking checks these things. And it's like, wow, that's really interesting. Yeah. So as things were winding down at my job, so I was there working investor relations for like 2.5 years, and not for nothing, but I'm a pretty quick study. So I picked up a lot in those 2 years, especially writing on my own and doing a lot of reading and stuff. And then when I came back to Philadelphia after that company had run out of money, I was looking for something to do. So I looked up geo investing, and I was like, I love this report on Longway Petroleum, and I like the kind of due diligence that you guys do, and I think I would fit in very well. Because I'm good at that type of stuff, and not just the financial end of it, but also I'm good at deductive reasoning, and I'm good at problem solving, and I'm good at logic, and I'm good at, basically just not buying bullshit. And, and there's things I'm bad at too. Like I'm a terrible forensic accountant. Like I'm just, I'm not a great forensic accountant at all. So I try to surround myself with people that are good at the things that I'm bad at. And I just said, look, I'm also a decent writer. I've been writing my whole life. So if you're looking for somebody to write and to help out, I'm back in Philadelphia and I'd love to do it. And they said, sure. So I had a, hour or two phone interview with Dan David, who was the head of geo-investing at the time. And if you've seen the movie The China Hustle, you know that he's like the featured guy in The China Hustle, which is a movie basically about China ripping off the U.S. markets. I make a 4-second cameo, maybe less. Mark Cuban, the owner of the Dallas Mavericks, helped produce the movie, so it got some pretty wide distribution. Dan and I, we saw eye to eye on a lot of things, namely just finding out the truth and telling the truth. That was it. And I started to work for them. And then I worked for them for 5 years, basically helping do two things. One was identify early stage potential microcap long investments that one of the partners there, Mansoy Dan, that was his bread and butter, and how he made his personal money and what he was an expert in. Really good at finding microcap companies. And Dan was focused a lot on the China side and a lot on these U.S. listed China-based frauds. So I worked with them for 5 years, just doing everything, doing research, doing equity analysis, doing investigative work, doing on the ground work, doing in the office work, traveling. And of course, over those years too, I had been maintaining my Quoth the Raven moniker. I told Dan when I started, I said, I want to be able to use my Quoth the Raven Twitter and all that shit on the side and not have that be a problem. Cause I knew the brand, the Quoth the Raven brand or whatever you want to call it, it started to have a following. And that was where I could put my brain farts. If I wanted to go complain about the Philadelphia Phillies somewhere, I could do that shit there too, which people that follow me, they know that I do that. So one tweet will be hey, this equity is massively overvalued. And the next one will be can you believe Gabe Kapler took Aaron Nola out after 60 pitches in the fucking sixth inning, right? So he said, okay. And so I started to do the two things concurrently. I ran my personal Twitter, which amassed a following over those 5 years. And
how many people do you have following you on Twitter right now?
I don't know. I don't know. I think there's 70,000.
Yeah, so it's substantial. I just asked that question because I think for my viewers, if you want to follow someone who's got an Austrian view, has a good macro view, but also really, really understands things, from being in the trenches, from a bottoms up standpoint, I think you're the guy. So so then how did you start the podcast?
Well, what happened was, while I was at Geo and I was identifying all these characteristics of fraud in companies, and all different types of companies and all different types of fraud, ranging from intense complex accounting fraud to, again, the factory that we said we have doesn't exist in China, that kind of fraud, and everything in between. While I was doing that, I started to kind of hone my understanding of macro as well, right? So as I was never macro first. I was always company specific first. So, it was always for me learning about how to discount a stream of cash flows, or, how to find a company's total addressable market, or all this other shit that was company specific. Then at some point I started to look at the bigger picture and notice what was going on from a global perspective with central banking and with the global economy as we call it, and the money supply. And you start to learn about all of these things, right? And you learn that basically, countries and central banking, there's a lot of similarities between individual equities. Countries have balance sheets too, central banks have balance sheets too. So, and when you look at that and you realize what we've done here over the last 50 years with taking the money off the gold standard and then, manipulating interest rates and performing QE and then QE again and then QE again. And now not QE, which is, Ben Bernanke's, Jerome Powell, whatever, they both suck. Jerome Powell's kind of insult to your intelligence that this $1 trillion that they've injected into the repo market is not QE. Like, is that like a fucking insult to your intelligence or what? Right?
It's a temporary glitch, Chris. It's just a temporary glitch. Don't
It's
worry.
ridiculous. So you start to realize that, and slowly but steadily, it has dawned on me through a rudimentary kind of understanding of central banking and the global economy that these guys don't have any fucking idea what they're doing. And not only that, but they are gaming the system for benefit of, politicians, for benefit of the rich, for benefit of elected officials, and for benefit of themselves, because they don't want to be heralded as anything but geniuses, and any type of blip on the radar as it from volatility standpoint or a recessionary standpoint, automatically like pins them as the bad guys. And the problem is that they've been putting off, as Peter Schiff would say, taking the medicine, right? Which is, we're going to need higher interest rates at some point. I mean, anybody that thinks we can continue down this path that we're on is sorely mistaken. They're just putting it off. And the longer they put it off, the bigger the problem's getting. And the bigger the problem gets, the worse it's going to be when we do have to take the medicine. So, as I said in my recent speech at the Stansberry conference in October, you can either believe that this is a group of people that have a firm understanding of what they're doing and know 100% what the effects of leading us down this unprecedented path are going to be, or you believe that this is the biggest long con of all time, which that's what I think. I mean, that's kind of the bluff that I'm here to call. I can't help but think that because, oftentimes when you have elected officials and you have people that work for the government and you have people in central banks, the common folk, right, the guys that I'm friends with, the guys that work at factories and are fucking plumbers and are, auto mechanics and like the everyday people, those people kind of operate under this assumption that people at the Treasury Department, people at the government, people at central banks know what they're doing, right? They operate under this assumption that these people are put in these positions because they get it. And the truth is they don't fucking get it.
Not only that, I'd add that they think that the stock market is the economy.
Correct.
Yeah. So let me go, let's see. So we're going off on, one thing I'd want to submit there, get your take on. I did a video on this the other day, but did you see that report that Zoltan Pozar came out with the other day? He came out with it on December 9th. Did you hear about that?
No, I didn't.
Okay, so this is a guy with a big shot with Credit Suisse. And I guess he's really famous with the CNBC crowd, all the talking heads. So he came out with this.
That's why I've never heard of him.
Yeah, exactly. So he came out with this report December 9th saying that by the year's end, the Fed would have to go back to QE4, official QE4, where they're buying coupons and not buying just T-bills. And his rationale for that was GSIB and some of these other strains that they have on liquidity, and that the Fed is going to have to do something, and they're going to have to do something huge, or else you're going to see tremendous spikes in not only the repo market, but the foreign exchange swap markets and so forth. And then on the 12th, so 3 days later, the Fed came out with their, I just looked at the update on the New York Fed's little repo agreement or repo operation site or page on the website. And it says that now they're going to go from 120 to 150 billion a night for that, like a 4-day period over the new year. And they're doing an additional 75 billion on top of that. That's like a 2-day
right? Why the fuck repo. Not? Make it $1 trillion.
Yeah, but the point is that, you're saying how the Fed just has no clue. And if you look at it, it's obvious. I mean, before Zoltan came out with that, and whether he's right or wrong, that's a whole other debate. But he comes out with this on December 9th, and sure enough, 3 days later, they upped the repo just for the specific time
Right.
frames that he was worrying about. It basically shows that the Fed is totally behind the curve, and now they're taking cues from just random people who do blog posts on
100%. I
on
mean,
the internet.
I don't know if you're going to be able to draw the correlation directly there between that blog post and that happening. It's an interesting coincidence. I don't believe in coincidences. Anybody that follows me on Twitter knows that. Would I be surprised if I found out Jerome Powell was taking his cues on central banking and also, which also happens to be, holding in the balance the entire global economy? Would it surprise me if I found out that he was taking his cues on monetary policy from Twitter or CNBC? The answer is fuck no, it would not surprise me. I mean, look, I've watched the guy stumble through enough press conferences
Yeah, yeah.
and backtalk and reverse what he's saying. I mean, just in the last 6 months, I've watched him get up behind the podium and change. I forget what was the one thing he said the one time. It was transitory or it wasn't transitory or whatever. He throws terms in, he throws terms out, he gauges the market reaction to them. I mean, I just think the guy's a liar. I think he's a liar. There's a couple different schools of thought on whether or not the Fed actually understands the problem and they're just doing this and trying to pull the wool over people's eyes, or if they're just so dumb that they just believe their own bullshit. Like Bill Fleckenstein says on my podcast all the time that, he just thinks the Fed, they just believe their own bullshit. I happen to think that, there has to be somebody that's halfway sentient somewhere in one of those organizations that realizes, hey, like, look, if Jim Chanos says to me, and he said to me like a year ago, we were talking about monetary policy, or maybe 2 years ago, but he said it's an unprecedented experiment and we're on an unprecedented path. Right? Would I take Jim Chanos in terms of smarts over anybody that has ever stepped through any lobby at the Fed over the last 5-10 years? The answer is yes. It almost doesn't matter. I mean, would it surprise you if that's where they were taking their cues, from a blog post?
No, it wouldn't, but especially because Zoltan is supposed to be a specialist on the plumbing of the whole financial system. And I think he actually used to work at the Fed. So they might have that, relationship. But what shocks
They
me.
are, Schiff said yesterday on some video I was watching of him talking to Kitco, he said the Fed hasn't, I forget what he said. He said something like
I think
the
you
Fed.
tweeted that out, didn't you?
I did. The Fed hasn't fought inflation. The Fed has surrendered to inflation. And that's what's happening. And you can fuck with the CPI and the hedonic adjustments and all this happy horse shit as many times as you want. But at some point, the genie is going to get out of the bottle. The inflationary genie is going to get out of the bottle. And it's inevitable. It's inevitable, right?
Yeah.
The only question is when. And I mean, personally, some people think it is already out of the bottle. You look at, the numbers that the CPI gives you versus actual inflation, what you pay for, a newspaper today versus what you paid 2 years ago, and you see the difference, and everybody sees it. I see it in the price of the groceries that I pay here at home. I mean, people just, what was the other thing I was looking at yesterday? Oh, the price of Christmas trees. There's this great Twitter account, Hipster Trader, and he put up this graphic. The price of Christmas trees has doubled in the last 10 years. Now, I understand there's a commodity involved there, and lumber has also risen as a commodity over those 10 years, I'm fairly certain. And that needs to be accounted for also, too. But the idea that this inflation is something that we have under control is ridiculous. Meanwhile, when you go to open a bag of potato chips now, remember back in the day, you used to open a bag of potato chips, it'd be full to the top. The bags keep shrinking, and the amount of air in them keeps getting bigger, and the product. So it's companies' jobs to just find ways to just, fuck with people. I was looking at candy bars the other day. This is the shit that I do on a daily basis. I was in Wawa. Like a couple weeks ago. There's a Wawa next to the bar that I like to go to sometimes on Sundays. So I had a couple of drinks, and I wandered next door, pick up cigarettes for the bartender, and just get a snack. And he wanted a Reese's bar. So I was standing in front of the candy counter, and I was looking at how candy has evolved. Like, it used to just be you'd buy a Butterfinger bar, and it was a normal Butterfinger bar at
It
a
was a
regular.
huge one. Remember the
You,
huge one?
you can't even buy regular ones anymore. They're all on the bottom shelf, right?
Yeah.
And and what I was doing was dividing the net weight of the regular sized product by the price it was being offered at.
Mm.
And then I was taking the king size bars and dividing the net weight of that product by the price that it was being offered for. And when you made the step up in size, the price went up. But relative to a per ounce, price, it was more expensive to the consumer.
Right.
So the entire world is replete with these ways for companies to try to cut costs, and that's part of capitalism too. But also it's a reflection of trying to get more bang for your buck. And
Yeah. And one thing I'd love to get your take on,
hang on,
and
there's something crawling on my ceiling over there that's bothering me, and if I don't go kill it now, it's gonna piss me off, and I'm gonna spend all night worrying about whether or not the thing is fucking like in my bed with me. So I'm just gonna take care of it. It's gonna be 30 seconds or less.
cool, handle it.
Yo,
Got it?
problem solved. Hopefully that was
Cool.
quick enough so we don't have to edit it out.
Yeah, no problem.
These things
Okay.
happen.
So what I'd love to get your take on is I've really come and look at this through the same lens. And my big thing is, yeah, you might go through a little bit of deflation first or a lot of deflation, definitely go through some asset deflation. But in the long run, you've got to get to inflation. And the Fed can't fix all these problems simply through money printing. And a lot of the rebuttals, if you want to call them that I'll get online or on my videos or on Twitter is they'll say, nah, you're over exaggerating the downside. The Fed can always come in and prop up the market. Look at Japan. They've bought, half their the market ETFs. They've bought all the bonds. So if anything happens in the equity markets, the Fed can always come in and just print the money. And I always say that's true to a point, but the kryptonite and the flaw in that is inflation. Inflation trumps everything because once they get inflation, or the CPI, the way they look at it, if it does get up to 6, 7, 8%, then and the market starts to go down, how can they justify or how do they print money in order to prop that market up when it's just going to exacerbate the inflation problem?
They can't. They'll have to raise rates.
Yeah, exactly. They got to raise rates. So is that how you see it as well? And what do you think would be
Well, I think the funny
next
thing is
step?
that there's so many people, especially politicians, focused on the wealth gap and inequality in this country, and nobody seems to understand that there's no greater exacerbator of the wealth gap in this country than the Federal Reserve, and that by inflating the money supply and printing more money, all you're doing is continuing to widen the wealth gap, right? Because that fucking money, gravitates towards the haves and away from the have-nots, and so that's a huge problem, and just one of the big signs that I think politicians and central bankers are missing. They're worried about now, like, well, what are the effects on climate change going to be on monetary policy? It's like, what are you talking about?
Yeah,
Right.
right.
So, to go back to your question,
What do you think triggers that inflation? Because it's end game. I think it's the end game. Schiff, all these guys think it's the end game. And even the guys that are bullish on the dollar short term, like a Brent Johnson or a Jeff Snyder,
sure.
Even those guys think, the dollar will go up to whatever they think, 120, 130 on the DXY, but eventually, 5 years, 10 years down the road, the dollar's toast. So what do you think is the catalyst, or have you thought about that?
I think a lot of it has to do with psychology, right?
Right.
A lot of it has to do with market psychology and the market realizing all of the stuff that we're saying. Things haven't gotten so crazy and so out of hand that people have been able, this is a problem that exists on bedrock that kind of usurps the entire system. And it's very difficult for people to step outside of the box and look at a problem. It's like the analogy of a house, right? now everybody is kind of in the house making little patch ups and putting new photos on the wall and patching the drywall, but the problem is in the foundation of the house, and in order to deal with the problem, you have to knock the whole house down, and you got to get to the foundation. It's the same thing with market sentiment and investor psychology. These people that are kind of walking around telling themselves that everything's fine. There's you can look at that in many different ways too. There's millions of Americans walking around with shitloads of debt. Just saying like, well, it'll get taken care of, or student debt. Like, oh, just I was talking to somebody last year that has money in the bank to pay off their student debt, but refuses to pay off their student debt because they think it's just going to get taken care of elsewhere. They just said, my financial advisor told me to just leave the debt there, and hopefully there'll be legislation or something that passes that takes care of it. So when we have that kind of, and really the market, the central bankers, the discourse from politicians, the discourse from analysts, the discourse from people on CNBC, they enable that, and they encourage that type of thinking. So it's going to take a very broad psychological shift in the way that we think about things. And when that happens, that's when you're going to see the gold move to 5,000, that kind of move. Like that's when you're going to see commodities just go ape shit. That's when you're going to see gold, go ape shit. That's when, and that'll catch on like wildfire, like it does. Look at 2008. It's a perfect example. It's a different situation, but it's an example in capitulation, right? Like everybody went to bed one day and everything was fine. And the next day they woke up and all of a sudden the whole fucking system was about to come down. And, fear spreads very quickly. And these types of situations get worse. Very, very. You ever hear the expression, investors take the stairs up and the elevator down? Right. That's what I think is going to happen here. But I don't know what is going to prompt that shift in psychology. I'm different than Peter Schiff in the sense that I really have difficulty putting a timeline on things because we haven't done this before. So anybody that tells you they know when it's going to happen and what the catalyst is going to be, I think I don't buy that. I don't get it because we've never done it before. And, most of the other big, giant recessionary problems in the market, people have had a lot of trouble seeing coming in advance. So we won't know the brick wall until we run headfirst into it. We won't know the genie's out of the bottle until it is. And then it's going to be too late. So it's a question for me personally of knowing what I know and looking at the system through the lens that I look at it. Would I be all right going 40 years until I die with the market just continuing to go up and this, bullshit kind of nonsense solution from the Fed continuing to work? Yeah, fine. Like I own some stocks. I own some things that would do well. I own real estate, things that would do well if markets continue to just appreciate and they're able to keep this stuff under control. But I also have a significantly larger portion than most people in the types of assets that would appreciate significantly in the events like we're talking about. And so for me, look, I'm a libertarian. I want people to do whatever the fuck they want to do. I don't tell people what to do. For me, having a physical position in gold, that makes me feel better. I don't know. I keep it next to my guns. Maybe I'm a conspiracy theorist. Maybe I'm a tinfoil hat guy. You can call me whatever you want, but that makes me feel better. That makes me feel like, okay, in a worst case scenario, I'm prepared. I'm happy that that I see things through the lens that I do. I'm happy that I came into finance through this back door and I wasn't churned out of some Ivy League institution.
Well, I think that's a huge edge for you. I think that's a huge edge.
I think so too. And I'm not putting down institutions, but to some degree I am also. But hold on, I want to finish the sentence, but I need more coffee.
Sure.
All right. But yeah, I just don't. I have trouble saying it's going to happen next year. I have trouble saying it's going to happen next month. I think that's where a lot of perma bears, as they're called, are misunderstood. I think guys like Peter Schiff are misunderstood often. He's a guy that understands the theory and understands the foundational bedrock of a theoretical problem that is almost an ideological and philosophical problem at this point. It's almost not even a problem in mechanics yet because people can't really wrap their head around that. So it's almost an ideological problem. He understands it exceptionally well, right? Nobody knows the Austrian school better than Peter Schiff. Nobody understands the basic financial tenets better than he does, right? The problem is, how do you deliver that to people that are still inside of the system? Is he just looks like a fucking crazy person to those people, you know?
Right.
So, the people that say, oh, he's a broken clock, and a broken clock's right twice a day because, hey, he got 2008 right, but, for 10 years he's been wrong. Well, for 10 years, he hasn't been wrong. He just hasn't been proven right yet on his larger contention that the entire system is flawed. So
Yeah.
he could be called wrong, but at some point, I believe he will be proven extraordinarily right. Now,
Yeah.
when does that happen and how does it happen? I don't know. But what I do is, again, I have some assets that benefit from the Fed system, and I have other assets that'll appreciate more than usual, more than an average investor. I like to have 20, 30, 35, 40, even at 50% of my assets in the types of things that will appreciate. And you get the best of both worlds too. If you own a bunch of oil companies, and the market hits all-time highs, they're going to do well, even if the price of oil isn't rocketing with the market. So you get a little yield there. And also too, like, if shit goes haywire, well, what's going to happen? The price of oil is going to fucking spike, and those companies are going to do well too. So there's ways to kind of play both sides of the coin. But what I don't like and what I advocate against is people just coming out and blanket disregarding anybody who has an Austrian viewpoint or a skeptical viewpoint on things. I think that does a huge disservice to the average investor. So in June, I did a speech in New York at the Benzinga conference called Perma Bears Are Not Ridiculous People. And it was a response to an article that Josh Brown, the CNBC commentator, had written called Perma Bears Are Ridiculous People, where he was, jovially, kind of casually ribbing a perma bear that, got one thing right for the first time in 20 years or whatever it was. But I don't think having that out there I think it's an arrogant way to look at things. And I think that stuff is going to be found by history to not have done us any help in the long run, where just coming out and saying, keep an open mind and look at both sides of the coin. I think over a longer view, 50 years and 100 years, I think that will be found to kind of be the more pragmatic and the wiser way to look at things. But
yeah, I agree. For me, I retired in 2012 and I started investing. I invest mostly in real estate, but I came to the conclusion through a lot of trial and error that I can't predict things. There are no certainties in investing. There's only probabilities. And that worked very well for me because before I even got into business, my big thing was playing blackjack, which is just a game of probabilities. So the only conclusion that I could come to for my personal investment strategy was, listen, I don't know if XYZ asset is going up or down, and I don't really care. The first question I ask is it cheap? If it's cheap, then I buy it. If it's expensive, then I sell it. And I know that I'm going to miss out on a lot of gains. I'm going to miss out on this. But if you do that over the long run, you've got the probabilities on your side. You're going to make money. And a lot of these people, and I think this goes back to your point about the Austrians and them making fun of Schiff and all that they'll say, yeah, but if you listen to Peter Schiff, you would have been out of the market for the last 3 years and you would have missed all these gains. Or, if you didn't buy into the housing market in 2017 when it's obviously overpriced, you would have missed out on all these gains. But for me, that's like looking at blackjack and getting a 19 and hitting on a 19 when I tell you, that's probably not a good idea. And you get a 2, you get blackjack. And they say, oh, see, George, if I would have listened to you and if I wouldn't have hit on that 19, I wouldn't have gotten a blackjack.
Right.
And I would have missed out on all those gains. Well, yeah, that's maybe true. But since the probabilities aren't on your side, if you continue to hit on 19 over the long run, you're going to lose. You're going to go bust.
That's a good analogy. And if we were playing in a casino in a controlled environment where it's 6 decks and everything is regulated by the gaming commission, and all things being equal, that would that's an analogy that would make sense, but it doesn't make sense because we're not playing in a controlled environment. The blackjack analogy is, and I understand the point you're trying to make, and I think it's a very good point. But, the problem here is that at the core of the problem is this entity that can willingly change the game and change variables whenever the hell it wants. So even if first off, I agree with the idea that, hey, nothing is 99%, nothing is 100% a buy or 100% a sell ever. There's always, nothing is ever a guarantee, right? There's always at least a very, very, very small degree of risk. In many investments, there's way more than a small amount. But the analogy there of kind of pushing it and probability is a really difficult one to gauge because we've never done this before. So we don't know how far along we are and how probable it is. Like, we can't gauge the probability right now of there being 20 more years of a quote unquote bull market versus the whole thing going tits up tomorrow morning when I wake up, because we just don't know, because we've never been here before. Blackjack
and
is
there's no
very
price discovery.
Exactly. So if we were in a free market, that might make a little bit more sense, but we're not. Blackjack has all of these controls, right? You're only playing with 6 decks. You're only playing with 8 decks, or you're only playing with 4 decks or whatever it is. And what the rules are. Blackjack pays 3-2. You know that the dealer always has to hit on a soft 17. So you can gauge the probability according to that nice set of rules, but I also agree, like, hey, that I like blackjack too. So over the long run, if the dealer's got a 6, you got to get as much money on the table as possible. Anyway, you got to do it, right?
They're gonna bust, baby. They're
Yeah,
gonna
whatever. And sometimes I do stupid shit, but I gave up on. To some degree, I almost gave up on the probability in those games too. Now, like if I have a hard 20 against the 6, like oftentimes I'll just split. I just don't. I'm like, yeah, whatever. Take your fucking 1% additional house edge and shove it up your ass. You got a 6, and I'm betting on your bust, and that's it. I do the same shit in craps too. I know the games. I know the probabilities very well, but I've given up on it.
Yeah.
I'm there to have
So
fun.
one thing I wanted to get your thoughts on is kind of the merging of both of your worlds. So you got the short selling that you're obviously a professional and an expert, and then you got the macro, which you kind of learn just by being out there and understanding how the world works. And one of the shorts that you talk about a lot on your podcast is Tesla,
Yeah.
obviously. And it's just a fascinating story, regardless of whether you're bullish or bearish. It's really quite fascinating, and I love listening to the feed or the back and forth between you and Mark Spiegel. It's really it's very, very entertaining. But my thought is that so much of the battleground in Tesla, to me, and obviously I'm a beginner, so you
Right.
correct me if I'm wrong, but it seems the battleground is always the bottoms up, and that makes sense. But when I look at Tesla, I understand both sides, from the bottoms up argument, but it seems like it's even, maybe not more so, but it's a macro short as well, from the standpoint that if we go through a recession or interest rates go up and they normalize, then how does Tesla survive that
No.
when they've got all this, capex that they have to do, and they have to go back to the capital markets, even if they do have a quarter here and there where they make profit, assuming they've got to access the capital markets again. What does that look like when there's not
just
free
like
money?
the macro picture. They're a money-losing entity that burns billions of dollars in cash and has never posted a profitable year, that relies on low interest rates to carry their aggressive debt load without having to make detrimental and significantly difficult interest payments on, right? So they're carrying a lot of debt, and they have a money-losing business model right now, and that's the only thing you need to know. And the other thing you need to know is Tesla is, again, a experiment in psychology. It's a question now, and there's no tangible cash flow stream to discount to try to put an actual valuation on a company. You have a car company which should be trading at 8 times earnings, trading at, whatever it is. You can't even give it a PE because it's not earning anything. But last quarter they turned they somehow turned a profit.
Yeah, and
But
it's not just Tesla. It goes back to the Austrian view of a misallocation of capital and malinvestment, to where you look at Tesla, you
yeah,
look at Uber, you look at Lyft, you look at, I don't know if you saw that company, that SoftBank. Well, just look at SoftBank's portfolio, period. But
sure.
I even wrote it down here. I always forget the name. The SoftBank. The company was called WAG. Did you see
Okay.
that?
No, but
That
I don't need to.
listen. They put 300 million into this
hmm
company, and it's a dog walking app.
Yep. That
And
sounds about right.
yeah, but my point is, I always talk about a misallocation of resources, so the viewers can understand that.
The market needs a plague. The market needs a black plague of a recession to take
Yeah,
all of this just
malinvestment.
shit. I mean, it's just shit. It's not even malinvestment. Malinvestment is like too nice of a word. It's just trash. It's trash that we have gotten so indoctrinated into this euphoria that people believe they're investing when they invest
Right,
in some
right,
shit like that. You know, like look what happened with Massa and fucking WeWork, right?
right,
Like
exactly.
it's like, oh, just ignore everything and pour more money into it. Like what could go wrong? And here we are in like the greatest bull market of all time with people arguably the most delusional they've ever been in history when it comes to basic economic laws. I mean, we're so many standard deviations away from the norm. We don't even know where the fuck we are right now. But like, you know, even in that environment, the market took the WeWork IPO and it barfed it back out to
Yeah,
SoftBank. It was like, are you fucking kidding us with this stuff? Like, you know, so it's more than just malinvestment. I mean, the market needs a plague badly. We need to take all this. I mean, it's like 2000, right? We need all these .coms. Everything was .com. Everything was .com. Everything was .com, right? They're doing the same thing now as a service, right? Dog walking as a service. Well, what'd you do? Well, we took dog walking, we put it on an app. Well, that's not very innovative, is it? You know, all this shit. We just need we need a plague. Just wipe it all out. Like, yes, malinvestment, and that's what would happen. You know, we
yeah,
both
right.
know in a regular Austrian system,
In the business
any
cycle.
exactly, recessions are good because they
Mhm.
correct that malinvestment. You know, the market gets to puke back the rest of the shit that it doesn't want. But you know, like Jerome Powell said a couple of weeks ago, something like the Fed's job is to keep the economy booming at all costs, or so. He said something
Yeah,
like that. I'm like, are you kidding me?
right.
Like, what pathway are we going down when that is the line of thinking? Like, people don't understand. Markets go up, markets go down. Gas prices go up, gas prices go down. Soybeans go up, soybeans go down. But with equities and real estate, no, we can't have that. Everything's got to be geared, and the game has to be fixed and cheated so that these things only go up. And it's like, all
Yeah,
right, go ahead. You want to
yeah.
try to do that? You want to fuck with everything possible to ensure that that continues to happen? See what happens in the long run.
Yeah, then because the moral hazard just increases that risk exponentially. But one of the things that I see that really kind of lull people to sleep is this human tendency that we all have towards recency bias. In other words, whatever's happened the last 5 years, we're just going to extrapolate that indefinitely into the future. So since the market has gone up for the last 5 years, well, it's going to go up forever. Since the dollar's been strong, it's going to be strong forever. Since we haven't had inflation, then inflation's just gone. Inflation's dead. We never have to worry about it again. So let's just do MMT and just not worry about it. And
Good.
and then
Let them believe that, because that's what's going to make us a shitload of money at some point. You know, let them continue to believe that. And when you take what you're talking about and you apply it to like, wow, like there's been a whole generation of people that have come out of college and have come out of university
yeah,
that have been working in the financial world for now a
yeah,
decade, and they know nothing but pure euphoria. They know
yeah,
nothing but, you know, the Fed is fucking smoking the monetary crack and we're going full speed ahead. Now, they don't understand we're heading towards a brick wall, but yes, you're 100% right. You know, the Fed, I always say on my podcast, the Fed needs to think about our 200-year plan and not our 20-minute plan, right? The Fed makes
exactly.
policy based on what the market did yesterday. You're
Yeah,
giving them too much credit by saying 5 years. I mean, look at what happened last December when the market pulled back 15%.
Yeah.
Steve Mnuchin went out and called the heads of the banks. Like, everybody went into full panic mode. Is this the end of the world? Like, meanwhile, you look at a chart of the Dow, right, over like 100 years, and it just does nothing but go straight up. And then there's this little this tiny little look right here, just this tiny little dip. That's your 15% pullback, and people are freaking out. So there's going to be some real pain at some point, my friend George. Me and you are going to be positioned to slaughter it. Hopefully, we just need the one disaster. I hope the whole world doesn't go to shit enough that the banks and the brokerages all wound up getting burned down, because I'd like to collect some portions of this bet at some point.
Right,
But
you got counterparty risk. No counterparty risk with gold, that's for sure.
That's right, brother.
So, Chris, I appreciate your time, buddy. I'm sure you're probably pressed, but what I want to really get your thoughts on is you have interviewed some of the top guys in the business, especially like Bill Fleckenstein. I mean, he's someone that I've got a tremendous amount of respect for all the guys that you interview, but him especially. I mean, he is just he's an OG. He is a legit pro. So and then you've talked to a lot of guys. I didn't know you'd talked a lot to Chanos, or I don't know if you've talked to Einhorn or any guys like that. But with your experience being in the trenches, and then also talking to these guys on your podcast or talking to them at conferences, what have you learned? What kind of takeaways or principles have you learned that you've applied to your own investment philosophy that my viewers might be able to learn from?
Just be yourself and trust yourself and trust your own judgment. I mean, that's it. If you want to look at that from the perspective of how the podcast started, my podcast started because Tim Seymour, invited Bill Fleckenstein on CNBC and then proceeded to insult him when Bill Fleckenstein didn't carry his Keynesian narrative forward during this interview, which is something that Bill now tells me they've made amends, et cetera, and Bill will never go on CNBC. But that was the moment. I watched that a couple of times on YouTube, and I was like, you know what? Fuck this guy. I was like, I'm going to start a podcast because I like Fleckenstein. I think he's a genius. I think he understands things that most people in the industry wouldn't understand if they lived to be 150. So I said, I'm going to start a podcast and I'm going to talk to him, and let's see if anybody else finds this kind of content interesting. And here we are, 2 million downloads later, right? So
congratulations.
What did I, thanks a lot. And I'm not saying that to toot my own horn. I'm saying that to make the point that people are interested, right? Mm-hmm. So that was an idea for me because it was something just that I wanted to hear. And I was like, I'm not getting this anywhere else. And when it comes to how I invest, it's the same thing. At the end of the day, if tomorrow some company that I own goes to zero, I have nobody to hold accountable but myself. I didn't do the research right. I didn't think it out the right way. I misinterpreted this, that, or the other thing, whatever. And that's it. Conversely, when a company I own gets bought out, I say to myself, hey, like, I got it. Like, great job for me. And then, I don't like to blame people or make excuses. It's not my style anyways, but I see a lot of that on the street too. People pointing and saying, oh, this analyst told me this analyst told me that, and he was right, he was wrong. It's like, do your own due diligence. You got to trust yourself. It's scary to think that guys like Jerome Powell don't have fucking superpowers, and they go home to their wife and their kids and they think about these problems the same way that, well, not the same way, but they think about them using the same capacity that we have. He doesn't have some like oversized Mars attack style brain with an IQ of 350 where he's going to be able to figure this stuff out. He's just a regular human being, and it's scary to kind of learn that, but also it can be very empowering, because when you go to make your investment decisions and you wind up on the other side of a trade as a, guy who manages $2 billion, and you want to sit and you want to talk to him about it and you hold your own, you start to realize, like, these are just people. The amount of money a guy has doesn't determine how smart he is. It doesn't determine, how good his investing style or approach is, any of that. So what I've learned is, and also too, the relationships that I've been lucky enough to make with some great people in the industry, some like bigger names in the industry, right? Like, so, I met, Whitney Tilson and Bill Ackman when I was involved with Herbalife, and like, I'm friendly with them. I'm friendly with Jim Chanos. I'm friendly with David Einhorn. I'm friendly with a lot of, the Nigerian brothers. I'm friendly with a lot of well-known people in the industry. How did I make those relationships? Why do those people even talk to me? That's a great fucking question. But I think the answer is because I'm just myself. Like, I'm not out there trying to be somebody I'm not. I'm not out there trying to, push some financial line that I don't believe in. Look, I know, like, for a fact, Jim Chanos disagrees with me on political stuff, probably across the board, right? But, like, he talks to me and I talk to him and we're respectful to each other. And, like, I really like him as a person. I think he likes me too. Like, I think he thinks I'm a decent enough guy. He puts that shit aside because, like, he's intelligent and he's got class. Like, so the people that you're going to want to attract to be in your inner circle anyways are the people that will give you credit and give you the due for being yourself. And so that's my advice. Like, honestly, I don't know how it happened, but at some point I became, like, pretty secure with myself. And I don't, I think almost to a flawed degree, to some
Right.
degree.
Yeah.
But, I don't worry about what anybody thinks about what I say. And I don't worry about, like, whether or not I have the approval of anyone when I say what I say. I try to be thoughtful. I try to be calculated. I try to consider other people's viewpoints. I try to drop the ego. That's, like, the biggest thing too. I try not to have an ego. It's easy in the industry because I don't really care, like, if I become Mr. fucking Finance World or I just sit at home and play Xbox all day. Like, either one of those sounds like a win to me, right? I got a lot of vodka in the freezer right now. I can walk the laptop over there and show it to you if you'd like. I got a nice big TV here in my modest little condo. I'm a happy fucking dude. So it's easy for me to just stick to what I believe in and believe in myself and invest in the things that I want. And if you want to come along for the ride, that's super dope. And if you don't, that's fine too.
Yeah. So it's for my viewers who are interested in understanding macro better, from an Austrian standpoint like you do, or maybe understanding short selling. I get so many people ask me, for investment advice. And I say, I don't know, I'd be a little leery of short selling unless you're pretty sophisticated, but from an Austrian standpoint, they're very bearish on the market. So if someone wanted to learn, maybe the macro stuff that you talk about or your vantage point from the Austrian school, or learn about short selling a little bit better, get the basics, how would you suggest they go about that? Whether books or podcasts other than yours, of
That's a good
course?
question. I mean, I don't really give investing advice, but the guys that I listen to are guys like Jim Grant, who is, not as loud and insane as I am. He's a very calculated and actually very witty and very thoughtful person.
He's a funny guy.
He's fucking hilarious. His podcast is great.
Yeah.
So I listen to guys like Jim Grant. I listen to guys like Peter Schiff and Bill Fleckenstein. I try to embrace all perspectives too. I like to, as much as I rag on them, I like to listen to people that I think are clinically insane on CNBC saying, the market's going to 50,000 in 2 years and stuff like that too, just because I like to know the data set that's out there. Short selling is inherently risky because it's the opposite of being long a stock. So when you're long a stock, the upside is infinite and your downside is 100% of your capital. And when you short a stock, it's the opposite. The most that you can make is 100%, and your downside is potentially infinite, right? So there's ways to define your risk using options and things like that, and you can go long instruments that perform well in bearish situations and vice versa. There's a trillion different ways to position yourself. My advice is, just learn the basics. Learn the basics of equity valuation. Learn what the different instruments are that you can use to, position yourself. Approach things with some humility and, be modest and thoughtful about the things that you do and not reckless and wild. Yeah, I mean, that's really it. I like to, when I look for things on the long side, I look for deep value and hard assets and, special situations and things like that. And when I look for things on the short side, Einhorn said a couple of years ago, you used to be able to short bubbles. You can't anymore. I look for over-levered companies and with negative catalysts on the horizon and management teams that have a history of, fucking up and commodity products with no moat and things like that. But yeah, I mean, I guess if you wanted to learn, a great place to start would be to one book that I've read that I really enjoyed was End the Fed by Ron Paul. And that was a nice book to kind of give me a little bit of history as to the Fed and what the purpose of. You got to learn that stuff. There's a couple of great lectures by Peter Schiff on YouTube. One is called "What About Money Causes Crises." The other one is called, I think, what do you? Just stay with me real quick. I'm going to look it up because I want to get it right. And they're two of my favorites. I've watched them a bunch of times. Like, What About Money Causes Economic Crises is one of them. And the other one's called The Fed Unspun, The Other Side of the Story. And that's like one of my favorites. The lecture is given to a group of kids, and Reason TV puts that up. Those start to give you a little bit of a feel just for kind of like what the Austrian school is, and learn it from the ground up so you understand exactly how far off the tracks we've gotten here. Don't try to take the Fed's thinking on things now and back your way into understanding economics. Start with the very, very basics. Like, dude, what were we doing 100 years ago? What were we doing 1,000 years ago?
Right.
So start with what history has showed us, and then move your way into where we are now. If you do that, things look very strange. If you try to go the other way, I think you're more likely to get kind of caught in the indoctrination of everything's fine the way it is.
Yeah, it's, in my opinion, it's just the difference between using common sense and models.
That's also a huge, very good point. Just use your brain, right? I grew up in a household where bullshit wasn't tolerated, and common sense ruled the day. And that economic common sense, like I just interviewed Jocko Willink, the Navy SEAL, and we were talking about economic common sense. And he was like, save your money and spend less than you earn.
Mm-hmm.
It's like, hey, that's it. That's common sense, right? Jocko's not a fucking financial analyst. He's not an economist. He didn't graduate with a PhD from Yale, but he's a fucking smart dude. He's quick on the uptake, and that is it. Use your brain, use common sense, and common sense is going to lead you to Austrian thinking to begin with, right? All you got to do is ask somebody, like, hey, would you rather be, what makes more sense if you're walking around with $50,000 in debt and no cash in the bank, but your goal is to go out and spend another 10 grand from a credit card, and that will make you economically healthy because you're spending.
Well,
that
I'll
makes
be more
sense?
richer. I'll be rich.
Right. Or would you rather have $50,000 in the bank, no debt, and not spend anything? Right. Only one of the two of those sounds good, but the Fed would have you believe otherwise. And so we've been brainwashed to think that going out and spending and putting yourself in debt is a great idea. And unfortunately, it's had a whole host of terrible consequences for the people that, don't have the financial sophistication to understand it. And they're good people, and that's what fucking sucks. Like, that's why I wanted to start a podcast. That's why I'm so outspoken, because like the people that I talk to and the people that I know, the people that I go to jujitsu with that ask me questions about finance, and the people that I worked with in Niagara Falls at this factory that I worked with, and the people that I lived next door to when I lived in South Philadelphia, like, they're all good people. They want honest answers. It's just sifting through the bullshit that is difficult for these people. And why wouldn't it be? Like, the Fed and the government have created financial jargon and a system that is just, looking from the outside in. It's like you're looking at hieroglyphics. It doesn't make any sense at all. So that's why I like kind of pulling the curtain back a little bit.
Yeah, that's what I try to do on a lot of my videos. It's funny you say that, because I did a video on that Zoltan Posar's post that he did online through Credit Suisse. And what was funny is I kind of just broke down his summary paragraph by paragraph. And one paragraph he had, I was reading it out loud, and then I'd explain what he's saying on the whiteboard. And this paragraph, it was 3 or 4 sentences. You get done reading it, and there is no way any human being could understand what he just said. But then when you think about it, and I just did it up on the whiteboard, all he said is that there's going to be a lot of sellers of treasuries and no buyers, so the Fed's going to have to come in and buy them. That's literally all he just said. Just a third grader would understand it. But the jargon that he used to get that point across was like some sort of language from outer space. You couldn't even decipher it. And I think My frustration is a lot of my viewers, just like a lot of your listeners, average, ordinary guys, really super smart at what they do, but they don't understand the jargon. So they think that these guys on Wall Street who write this stuff or that you see on CNBC are so much smarter than they are.
Right, and they're
They
not.
could never understand it. And it's not
Right.
that they're smarter, it's just they're using a different language. And
You're
once you
100%
understand the
right.
language, it's all just basic
You're
third grade
you're you're
concept.
100% right. So it's third grade math once you get there. So start at the bottom, right? Learn what a bond is, right? And that's how I learned. I mean, I remember like 10 years ago or 15 years ago, like I just Googled, like somebody used the word debenture. And I was like, how the fuck am I supposed to know what that is, right? And then you look it up and you're like, oh, okay, like it's an unsecured bond, right? And I'm like, all right. Well, I had like learned what a bond was before. Just start at the bottom. Learn what equity is, learn what debt is. Start at the very, very basics of finance, right? I wish I knew a book that just taught like finance 101 from the Austrian perspective, but start there and then like learn kind of outwardly from there. And the more you learn, by the way, and I still have these moments, the more you learn, you're just going to have days where you're listening to CNBC or you're watching the Fed presser or you're reading fucking Neil Kashkari's Twitter and you're just like,
Yeah.
you're like, are you kidding me? Like, really? Once you get over the fact that, like, yes, it really is as fucked up as everything seems. Like, you're not on candid camera, and you're not having some big misunderstanding, right? This really is the whole thing has really gone to shit the way that it looks like. Once you understand that, then it's just then you get frustrated and make your own podcast. But the jargon is one of the things that I hate, and it took me years of looking things up on my own and really nice people that I'm friendly with that helped me understand these things, especially because like I didn't go to school for it. So I didn't learn the definitions of, macro terms and equity analysis terms and stuff like that. So, I remember specifically, like I remember Googling debenture like 15 years ago. I was like, what the hell does that mean? Like, what is a tranche of debt? I was like, all right, I looked that up too. Like, and even now there's things that I don't understand. Like I didn't understand the repo market real well. And now with this recent issue that we've been having, so like 2 months ago when it first became an issue, like I understand that rates spiking means that there's a problem, right? That there's, there's a risk profile is changing somewhere and that there's not enough liquidity and it's a problem that should probably work itself out and not be intervened with. I understand that, but I didn't really understand what the hell the repo market was. So I called my friend Kubiko on Twitter, who is a genius, and I do this to him once in a while. And I just said, hey, like, can you just tell me like a little bit more about the repo market? You just explain it to me. All right, here's what the overnight repo market is. It's a place for, extremely short-term lending for things like, treasury bills and very like hard assets that haven't settled, and are guaranteed to settle. So it's just a very short-term lending market. And I was like, oh, okay. So I still have those moments. I'm still learning, like, and I look forward to it. The only problem is the more you learn, the worse things look. And,
it's that red pill. It's that matrix red pill.
That's it. So start with the basics and try to work your way out from there. Don't try to back your way in.
Well, I think the great news and the takeaway is that I'm sure, so many of your listeners have a tremendous amount of respect for you, just like I do. And a lot of my viewers, they think that I get up there on the whiteboard and that, they've got a lot of respect for that. But if you look at it, there's just two guys, you and I, who have never taken an econ class, or maybe you have. I've never taken a finance class and basically just self-taught. And if we can do it, I think that any of your listeners or any of my viewers can do it as well.
Listen, man, I had a moment when I was like 20 years old or like 19 years old when I came home from college and George W. Bush was the president. It was like the beginning of his first term. And I went out to lunch with my mother. And I remember saying to my mom during the ride home, like, this guy doesn't seem that smart. I don't know what it was at the time, but I remember it prompted me to tell my mother, like, this guy just doesn't seem smart. Like, maybe it was when he said, fool me once, we can't get fooled again, right? I don't know. It was one of his things. Fool me once, shame on you. Or fool me twice, well, we can't get fooled again, right? Or something. And I was like, fuck is with this guy? I used to think like you had to be the smartest person in the world to be the president, right? Because like you're controlling the whole world essentially. And you learn like that's not how it works. And so so you start to learn like the world is replete with people that are not that intelligent. And I remember having this realization that day, like, man, you know what? I'm pretty good at following directions when I put my mind to it. And I feel like I have decent like capacity. Like I can understand things. Like, you know, I bet you I could like fly the space shuttle if I wanted to. Like these guys sit down, they read through a book of procedures. Like, I don't know physically if I could do it, if I could withstand the G forces of it. But, you know, you train and you learn from people that understand. And like, you know, I could probably do that if I wanted to. Like, and I'm just thinking like, fuck, man, if this guy could be president, like, I could probably be president, right? Like, I imagine he's got advisors, he's got people surrounding him. Like, hey, you just got to learn that. You got to understand that. You got to understand that, like, look, I'm not the smartest person in the world, and neither are you. We're just two fucking regular schmucks, but we figured some of this stuff out. And I tell you what, like, you're probably well ahead of the bell curve of most people. You know, you're probably of above average intelligence, right? But you don't have to be, you know, you don't have to be some finance major. You don't have to be some genius to figure this stuff out. It all boils down to if you look at it from the ground up, it all boils down to third grade math. You know, your market cap is your outstanding shares divided by your price, right? Or your outstanding shares times your price, right? I mean, there's every financial measure. Your price to earnings ratio is the price of the stock divided by what the company is expected to earn over the next year on a forward basis, right? Everything is like pretty simple. You take one number, you mash it with the other one, and then you get these, you know. So don't be discouraged when you hear, oh, this company's quick ratio is this and their current ratio is that. And, you know, the gross margins and the net profit margins and the net income and the revenue and the cost of goods sold. And it's like, hey, man, everything has a very simple definition. Problem is there's a lot of fucking shit and you just got to take it little by little and just read your way through these things. And great way to do it is to read annual reports from the top to the bottom. Because a lot of times
to understand things from the bottoms up on the
well, it helps if you're looking at a company. Like the first thing I do is just read their whole annual report because it tells you everything. It tells you where they're headquartered, how many employees they have, what year they were founded, the whole history of the company, what their past plans were, what their future plans are. Lays out, you know, the MD&A, gives you the risk factors. Should, if the company is behaving, like give you everything. So that's a really good way to kind of, if you're going to look at a company, to start from the ground up. And when it comes to macro, man, and the understanding of finance, you know, the basics from an Austrian school would be my recommendation. But unfortunately, I don't have like one go-to like Bible that
I think Schiff has that one book. What was that called? It's right on the tip of my tongue. It's How Economy Grows and
why it crashes or something.
Yeah, something like that, where he starts off with like a very simple economy with these four guys in a village that are fishermen, and they get a net, and that makes it so that technology makes it so the one guy can catch enough fish for all four of them, and then the other three guys go off to do it, and then the economy grows, and he just kind of walks you through it. I wish I remember the name of that book.
There's two really good videos online too that I remember seeing like years ago. Like, I don't really agree with Ray Dalio on a lot of things, but his video on like how the economy works lays out a lot of the very, very, very basics for somebody that is looking at the economy for the first time, even breaking it down to the fact of, hey, what is the economy? Well, it's just, you know, it's a trillion little transactions all happening at the same time. That's a pretty cool video. I don't agree with him on some things, but that's a cool video to kind of get an understanding of, you know, the basics of booms and busts and basically how the mechanics of the economy, how credit works, things like that. And Ackman did a video some years back too about like
remember that.
starting a lemonade stand.
Like a whiteboard video.
Yeah, and he goes through. It's like Bill Ackman. I think it was through the Floating University, I think it was called. But you can Google it, like Bill Ackman, everything you need to know about finance in 20 minutes or something. And he just runs through a basic example of a lemonade stand and, you know, how things hit the financials and, you know.
He goes through like a balance sheet of a lemonade stand or something.
Yeah. And that, you know, that's another cool little example. But I wish I could remember, like, I wish I had something more comprehensive. But it's mostly, for me, it's been like a decade of just piecemeal, man. You know, even more than a decade, 15 years of just picking it up little by little, man, and still doing it to this day.
All right, buddy. Well, I appreciate your time. I appreciate you being
Sure.
on the show, and it's great. I think everyone's going to love it, and I think they're really going to learn a lot.
Awesome. Yeah. Thank you for having me. I'd love to come back anytime, and I really appreciate it. So thank you very much.
All right. For more of Chris's content, you can check him out on Twitter at QTR Research or his YouTube channel at Quoth The Raven. Or if you haven't subscribed to his podcast, make sure you do that right now. You're going to love it. For more episodes of the Rebel Capitalist Show, check out this content right here, and I will see you on the next video.